So here's a few macro views that we took recently. And again, these were extremely contrarian. This is a little bit of a busy chart, but what we're showing is 3 different specific views where, and we were looking for kind of like headlines to show opposite this, and maybe should have included that, but like we came out October 15th, the glut is over, Waha Hub natural gas is now at a premium. That day, Bloomberg had a headline article that was published the next day in many newspapers around the world talking about Waha natural gas prices going to 0 and how that would be problematic for a while. MidCon, November 3rd, we came out saying the MidCon market is at a premium and it's going to be at a premium for a while. Around the same time, there were headline stories across a number of newspapers and a number of outlets and a number of research analysts from investment banks saying that this would be problematic for a while. Similar with Canada this year, March 15th came out, good news for Western Canada. Canada's been a market that we've looked at intermittently and invested in intermittently over the last number of years. It's somewhere that we have a lot of expertise. At the same time, many analysts were expressing negative views on Canadian oil. There was lots of fear, uncertainty, doubt, kind of bad analysis going out there in a number of different ways. In each of these cases, we bought the stocks that were linked to these macro theses after the price was already at the point that we expected it to go to from a market perspective, but the stock prices hadn't moved yet. Again, there's been kind of this evisceration of the oil and gas sector. And so that's why it matters a lot to us to get our catalysts right. And if it's a macro catalyst, to do a lot of work and be right on it, because if we're right, the potential financial returns from being right on macro can be life-changing. And so if you see on the bottom of this page, and again, none of this is indicative of Bison's returns necessarily. This isn't an offer to invest in Bison. This is just showing getting the macro right can lead to literally life-changing returns. We excluded the name of the stock on the bottom left. That was most tied to Waha. We haven't disclosed that publicly yet. Sandridge was the company exposed to MidCon. Baytex was a company most exposed to Western Canadian differential. And each of these, we show not only the absolute performance on a percentage basis in blue, we also show the 2 relevant indexes to look at XLE and XOP, which are ETFs that people use to get exposure to oil and gas. So those are up, but they're up nowhere near as much as these specific stocks are. And this is, again, a reason to get the catalyst right and to get, if the macro is the catalyst, to get the macro right, because again, these can be absolutely game changing. One more kind of, this is a very busy slide, but if you look at the left, we show our thesis, which was that the MidCon was a premium. We also actually published our thesis on Sandridge. It's amazing because we put this out both on our website as well as on Seeking Alpha. We tweeted about it, and I mean, not only were there news headlines saying that we were wrong and not specifically addressing us, of course, but addressing this subject, but many comments are still out there in the public forum about how we don't understand this, how natural gas or natural gas liquids in the area wouldn't recover, won't recover, have all these problems. And again, it's kind of amazing because fast forward just a few months and the local price had already moved up by the time we bought it, but it went up even more and it got in the headlines during the Texas winter storm. And as you can see on the bottom right, Sandridge, despite having a strong balance sheet and actually net cash, so no debt, net cash, the stock has performed more than double the XOP index, and it's performed like 7x better than XLE, which again is kind of the standard index that people use to get exposure to oil and gas. So getting on the left, the macro right, getting the right financial instrument to express the macro view, or to the right, I guess the flip side of that is finding the right stock and understanding the catalyst and evaluating it correctly can lead to really substantial outperformance. And again, in this case, this wasn't about taking more risk. This is actually taking less risk. It was a low valuation stock. It had a strong balance sheet. It had turnaround management in that had been put in by Carl Icahn with a very specific no drilling, just like selling assets, paying off debt, building cash on the balance sheet, very low risk activities. So this was a lower risk way to earn a higher return, and again, driven by macro analysis. So again, if it feels like I'm hitting it over the head a little bit, it's intentional. It's remarkable what this sort of analysis can lead to in terms of the results from selecting the right stock. And kind of from a more general perspective, the more people hate something, the more they dislike it, the worse the sentiment is, the better the buying opportunity is. So you might be familiar with Sandridge from its pre-bankruptcy days. It had lots of negative press. It had maybe reckless or aggressive management. It had a number of activists and other people involved with it. The worse you emotionally respond to something, the more attractive it is generally as a financial investment, especially in the public market. And Sandridge is evidence of that. And then again, you can't just buy things that you hate. You have to buy things, in my opinion, that you emotionally don't like with the right research in place. And again, for this set of stocks that we showed, the thesis, the catalyst, at least part of it was driven by specific mispricings of macro. And now we're going to get into kind of this next macro opportunity that we're seeing that we think is driving significant opportunity.